The year 2008, remember it? It was a year that would go down in history. It was a financial heart attack, a sudden and severe shock to the global system. The world watched, stunned, as the global economy teetered on the brink of collapse. Lehman Brothers, a titan of Wall Street, collapsed, sending shockwaves through the financial world. Markets plummeted, panic spread like wildfire, affecting millions of lives. The cause? A toxic cocktail of subprime mortgages and reckless lending practices. But the aftershocks? Those were just beginning, and they would be felt for years to come. Governments scrambled to contain the damage, holding emergency meetings and press conferences. Their solution? Slash interest rates to near zero, making borrowing cheaper. Pump trillions into the financial system through quantitative easing, an unprecedented move. The goal was simple: avert a depression and stabilize the economy. They succeeded, but at a cost. The measures had long-term consequences. These emergency measures, intended as temporary, became the new normal, altering economic policies. And they lit the fuse for a new era of economic instability, one fraught with uncertainty. The world breathed a sigh of relief. The worst had passed, or so it seemed. But the crisis of 2008 wasn't just a blip, it was a seismic event. It was a turning point, a moment that changed the course of economic history. It marked the beginning of a dangerous new cycle, one that we are still navigating today. A cycle of boom and bust, driven by cheap money and government intervention, creating volatility. A cycle that has only intensified in the years since, shaping our present and future. Low interest rates were supposed to be a shot of adrenaline for a faltering economy, and they worked, initially. Cheap money encouraged borrowing and spending, businesses invested, consumers bought houses and cars, the economy perked up. But this sugar rush came with a bitter aftertaste. See, low rates create an illusion of growth. They inflate asset bubbles like housing, they encourage risky investments, they distort the natural ebb and flow of the market. And when the music stops, when rates inevitably rise, the consequences are severe. Quantitative easing, the other half of the equation, further amplified these effects. By injecting trillions into the financial system, central banks flooded the world with cheap credit. This propped up asset prices, fueled speculation, and created a false sense of security. The result? Shorter economic expansions followed by sharper, more frequent recessions. Nowhere is the boom and bust cycle more evident than in the housing market. Take the United States, for example. The 2008 crisis was triggered by a housing bubble that burst, leading to widespread foreclosures and financial turmoil. Yet, fueled by low interest rates and quantitative easing, the market roared back. Prices soared to new heights. Affordability plummeted, making it harder for average families to buy homes. Then, as the Federal Reserve started raising rates in 2022, the bubble began to deflate once again, causing a slowdown in the market. The story is eerily similar across the globe, with many countries experiencing their own housing market booms and busts. In the UK, house prices doubled between 2008 and 2022, creating a significant affordability crisis. Then came the Bank of England's rate hikes, and the market stalled, leaving many potential buyers in limbo. Australia and New Zealand experienced their own housing frenzies, fueled by cheap credit and speculative investments. Those bubbles too are now deflating, leading to a cooling of the market and concerns about future stability. Even the EU, with its more fragmented housing market, has seen soaring prices followed by corrections as the European Central Bank tightens monetary policy to combat inflation. These housing bubbles have real-world consequences that extend beyond the financial markets. They price families out of homeownership, making it difficult for many to achieve the dream of owning a home. They exacerbate inequality, widening the gap between the rich and the poor. And when they burst, they can trigger financial instability and economic pain, leading to recessions and long-term economic challenges. Section 4. The human cost, a roller coaster of jobs. The boom and bust cycle isn't just an abstract economic theory. It's a reality that impacts millions of lives. It plays out in the lives of everyday people. Take unemployment, for example. In the aftermath of the 2008 crisis, unemployment soared. Businesses shuttered. Millions lost their jobs, creating a ripple effect that devastated communities. Then came the recovery, fueled by, you guessed it, low rates and QE. Jobs returned. Unemployment fell, and optimism began to creep back in. But this job growth was often built on shaky foundations, with many positions being temporary or part-time. Many of the new jobs were in sectors inflated by cheap credit, like construction and finance, which are highly sensitive to economic shifts. And when the next downturn arrived, those jobs were often the first to go, leaving workers scrambling once again. The COVID-19 pandemic provided a stark illustration of this volatility, disrupting industries and livelihoods overnight. Governments, desperate to avoid another 2008, unleashed even more massive stimulus packages, hoping to stabilize the economy. Jobs rebounded quickly, but as the sugar rush subsided and inflation soared, central banks slammed on the brakes trying to control the overheating economy. The result? Renewed layoffs, particularly in interest rate-sensitive sectors like housing and technology, leaving many to wonder about the stability of their future employment. Section 5. Drowning in debt, a legacy of intervention. There's another often overlooked consequence of this endless cycle debt: government debt. To fund their stimulus measures and prop up their economies, governments have borrowed trillions. In the United States, government debt has ballooned from $9 trillion in 2007 to a staggering $34 trillion in 2024, more than 100% of the country's GDP. The UK, EU, Australia, and New Zealand have all seen similar debt explosions. This borrowing binge creates a dangerous trap. Continuing to borrow at this pace is unsustainable, but halting borrowing could tip these economies back into recession. It's a catch-22, and here's the rub: raising interest rates to combat inflation makes this debt even more burdensome. It's a vicious cycle. Governments are hooked on cheap credit, but the cure for their addiction: higher rates, risks triggering a debt crisis. Section 6. Trapped in the cycle. Can we escape? So here we are, trapped in a cycle of our own making. Low rates and QE create artificial booms followed by inevitable busts. Housing markets soar and crash, unemployment fluctuates, government debt spirals upwards, and each time crisis hits, the response is always the same. More of the same medicine that made us sick in the first place. Breaking free from this cycle will be difficult. It will require a fundamental rethink of our economic orthodoxy. It might involve accepting short-term pain for long-term gain. But one thing is clear: continuing down this path is unsustainable. The question is, do we have the courage to change course before it's too late?